What is the arm's length principle? Have you ever wondered how companies determine prices for transactions between related parties? This is where the arm's length principle comes into play. At its core, this principle is a key rule in tax and accounting, especially during transfer pricing audits. It states that when related parties, like a parent company and its subsidiary, engage in transactions, the terms should reflect what would happen if they were unrelated and acting independently. This means the prices and conditions should mirror those that would be agreed upon in the open market between two independent entities. Why is this important? Well, it helps ensure fairness and transparency in taxation. Without this principle, companies might manipulate prices in transactions between related entities. This could allow them to shift profits to places with lower tax rates, ultimately reducing their tax liability. Tax authorities relying on the arm's length principle to prevent such profit shifting. They want to ensure that companies pay the correct amount of tax. To apply this principle, companies must document and justify the prices and terms of their transactions with related parties. They do this by comparing these transactions to similar ones between independent parties. There are several common methods for making these comparisons. The Comparable Uncontrolled Price Method looks at prices charged in similar transactions between unrelated parties. The Resale Price Method focuses on the price at which a product is sold to an independent buyer, minus an appropriate gross margin. The Transactional Net Margin Method examines the net profit margin relative to a comparable transaction. During a transfer pricing audit, tax authorities will review these comparisons and the supporting documentation. They assess whether the terms of related party transactions align with market conditions. If they find discrepancies, they may adjust the taxable income of the companies involved. This can lead to additional taxes, penalties, or interest. Understanding and applying the arm's length principle is essential for companies involved in international business or those with related party transactions. Proper compliance helps avoid disputes with tax authorities and ensures that companies meet their tax obligations fairly. In the world of tax filing education and tax audits, grasping this principle is vital for maintaining transparency and fairness in business practices.